$121.62. That is the number that flashed across trading screens on January 29th, 2026. The highest price silver has ever reached in human history. Higher than the Hunt Brothers squeeze in 1980, higher than the 2011 spike, higher than anyone predicted, even 6 months ago. And then within hours, it started falling. 6% down, 8%, 10% at its worst. Billions of dollars in paper wealth, evaporating. Right now, someone is staring at their screen, watching red candles stack on top of each other, wondering if they made a terrible mistake. They bought at 115 or 118, or maybe right at the top, and now they are watching their position bleed. The financial media is already writing the obituaries. Bubble burst, speculation gone wrong, silver crash. The headlines write themselves. But here's what nobody is telling you. What happened today is not what you think. The story being pushed right now, the narrative you are hearing everywhere, it is wrong. And if you do not understand what actually caused this correction, you will make the wrong decision. You will panic sell at the bottom and become exit liquidity for someone else. By the end of this video, you will understand exactly what happened. You will see the real forces that moved this market. And you will know whether this is the end of the rally or just a pause before the next leg higher. But I need you to stay with me, because the truth is more complex than a headline. Welcome to the hidden economy. If you are new here, I cut through the noise and show you what is actually happening in markets. Subscribe right now, because what I am about to show you could change how you see this correction. Let me start with a number that should shock you. 65%. That is how much silver rose in January alone. Not in a year, not in 6 months, in 29 days. From around $70 per ounce at the start of the month to over $120 at the peak. In the same period, gold rose 30%, hitting $5,600 per ounce for the first time ever. These are not normal moves. These are historic moves, generational moves. The kind of moves that happen maybe once or twice in a lifetime. And when moves like this happen, something else always follows. Profit taking. Think about it. If you bought silver at $30 last January, you're now sitting on a 300% gain. If you bought at $50 in October, you have more than doubled your money in 3 months. At some point, people want to lock in those gains, turn paper profits into real money. This is not weakness, this is human nature. And when enough people decide to take profits at the same time, price drops. That is exactly what happened today. But there is more to this story. Let me show you the second force that moved this market. Right now, there's a clock ticking in Washington. Federal funding for major government agencies expires on January 31st. That is tomorrow. If Congress does not pass a spending bill, we get a partial government shutdown. This is not theoretical, this is happening. The odds of a shutdown have spiked to nearly 80% according to prediction markets. Senate Democrats are blocking funding bills over disputes about immigration enforcement. The House is in recess, and a winter storm has closed the Senate building. This is chaos. This is uncertainty, and markets hate uncertainty. When traders see political chaos, they reduce risk, take profits, move to the sidelines. They sell first and ask questions later. Now, here's the part that most analysts are getting wrong. I've seen headlines today blaming the dollar. They say the dollar spiked, and that is why silver crashed. This is factually incorrect. Let me show you the data. The DXY, the dollar index, is currently trading around 96. That is a 4-year low. The dollar has fallen nearly 11% over the past 12 months. The dollar is weak, not strong. In fact, the weak dollar is one of the main reasons silver and gold have been rallying so hard. When the dollar falls, it takes more dollars to buy the same ounce of metal, price goes up. The dollar did not spike today. Anyone telling you otherwise is either misinformed or lying to you. If you misdiagnose the cause, you will misunderstand the cure. The real causes are profit-taking after a 65% monthly gain, political uncertainty, and speculative positioning. Here is what speculative positioning means in plain English. When silver rallies this fast, speculators pile in with leveraged futures contracts. They bet that the price will keep going up. As more speculators pile in, their buying pushes price higher, which attracts more speculators. This creates what traders call an overcrowded trade. Everyone is on the same side of the boat. And when everyone is on the same side, it does not take much to tip the boat over. Someone takes profit, price dips, that triggers stop losses. Those stop losses trigger more selling, which triggers more stop losses. This is the cascade effect. This is what happened today. It was not a fundamental change in the silver market. Supply did not suddenly increase. Industrial demand did not suddenly collapse. Central banks did not suddenly dump their holdings. The physical market is exactly the same as it was yesterday. What changed is sentiment. What changed is positioning. What changed is paper. Now let me show you something that most people completely miss. Let me show you what happened in December. Because history does not repeat, but it often rhymes. On December 30th and 31st, 2025, silver crashed. Sharp sell-off, panic everywhere. people calling for the end of the bull market. Sound familiar? The sentiment was exactly like today. Fear, doubt, capitulation. And then January happened. 65% gains, all-time highs, the biggest monthly rally in decades. Everyone who panic sold in December watched the rocket launch without them. They became exit liquidity for the people who understood what was happening. Now look at today, January 29th, 2 days before the end of the month. Sharp correction, panic selling, headlines screaming about crashes. Same pattern, same timing, same fear. The question you need to ask yourself is simple. Do you want to be the person who panics, or do you want to be the person who understands? Let me show you what has not changed, because this is what actually matters. First, the supply deficit. Silver has been in a structural supply deficit for 5 consecutive years. Global mine production is around 830 million ounces per year. Global consumption is over 1.2 billion ounces. That is a gap of nearly 400 million ounces every year. And where does the extra silver come from? Existing stockpiles, inventories that have been built up over decades, and those inventories are depleting fast. This did not change today. The deficit is still there. The math is still the same. Every single day, more silver is consumed than is produced. Second, industrial demand. Silver is not just a precious metal. It is an industrial metal, and industrial demand is exploding. Solar panels. Every single solar panel requires silver, and the world is installing more solar capacity every year than ever before. Electric vehicles. Every EV uses more silver than a traditional car, and EV adoption is accelerating globally. Electronics, your phone, your laptop, your television, all contain silver, and the number of connected devices keeps growing. Artificial intelligence infrastructure, the data centers powering AI require massive amounts of silver for electrical connections and thermal management. This demand is not going away, it is accelerating, and it did not change because of a one-day price correction. Third, central bank behavior. Central banks around the world are accumulating precious metals at record rates, not just gold, silver too. China, Russia, India, they are not selling, they are buying on dips, buying on rallies, accumulating relentlessly. Did they suddenly stop buying today? No, they probably bought more because they understand something most retail investors do not. They understand that the long-term trajectory of precious metals is up, that the dollar's dominance is fading. They understand that real assets, physical assets, are the ultimate store of value. Today's correction does not change any of this. Fourth, the Federal Reserve, the Fed just kept interest rates unchanged. Chair Powell signaled the central bank is likely to remain on hold for some time. Inflation remains somewhat elevated, economic activity continues to expand at a solid pace, but the Fed is not hiking. What does this mean for silver and gold? It means the environment that has been fueling this rally is still intact. Real interest rates adjusted for inflation are still relatively low. The opportunity cost of holding precious metals is still minimal. The Fed is not draining liquidity, they are standing still. And in an environment of persistent inflation and policy uncertainty, precious metals thrive. Fifth, the weak dollar. I already showed you the DXY is at 4-year lows. But let me explain why this matters so much. When the dollar weakens, foreign buyers can purchase more metal with their local currencies. A Chinese investor, a European investor, an Indian investor, they all benefit when the dollar falls. This increases global demand. The dollar's weakness is not a bug in this rally. It is a feature. It is one of the main drivers of this historic move. Treasury Secretary Bessent reaffirmed the strong dollar policy, but President Trump has signaled he is comfortable with a weaker currency. This tension about dollar policy, this uncertainty, is bullish for gold and silver because it undermines confidence in the world's reserve currency. If you are still watching this, you understand something important. You understand that today's correction is a shakeout, not a breakdown. The fundamentals have not changed. The supply deficit is still there. Industrial demand is still accelerating. Central banks are still accumulating. The Fed is still accommodative. The dollar is still weak. What changed today is psychology, not reality. Let me tell you what I am watching over the next few days, because the next few days will be critical. First, the shutdown. January 31st is the deadline. If the government shuts down, expect more volatility. But here's the thing about shutdowns, they always end. Congress always eventually passes a funding bill. The government always reopens. And when the uncertainty clears, markets often rally. So if silver drops further during a shutdown, that could be a buying opportunity. Second, February price action. Watch what happens in the first few days of February. This will tell us a lot. If silver quickly recovers and starts making higher lows, that confirms this was just a healthy correction within a larger uptrend. If silver continues to fall and breaks below key support levels, that would be more concerning and would require reassessment. The levels I am watching are $105 and $90. A dip to 105 would be normal, still within the range of a healthy pullback after a 65% monthly rally. A break below 90 would suggest something more serious, but we are not there yet. We are still well above those levels. Third, geopolitical developments. Right now, tensions between the US and Iran are elevated. The EU just designated Iran's Revolutionary Guard as a terrorist organization. There are reports of the US increasing military presence near Iran. Iran has announced live fire drills in the Strait of Hormuz. If tensions escalate, safe haven demand for precious metals increases. Gold and silver both benefit from geopolitical uncertainty. Fourth, China stimulus. Any signs of economic stimulus from Beijing would be massively bullish for silver. China is the world's manufacturing hub. When China's economy accelerates, industrial demand for silver accelerates. Recent data has shown some weakness in Chinese manufacturing, creating fear about industrial demand. But China has a history of surprising markets with stimulus measures. Watch for any announcements from Beijing. Now let me give you some practical takeaways, because knowing what happened is useless if you do not know what to do about it. If you're holding physical gold and silver, my advice is simple: do nothing. 2. Physical metal is not a trade. It is insurance. It is long-term savings. It is wealth preservation. You do not sell your insurance because the market had a bad day. You do not have a loss until you sell. Until you sell, it is just a number on a screen. It does not affect how many ounces you own. Ignore the daily noise. Come back in 6 months. The fundamentals have not changed. Only the short-term price has changed. If you are trading with leverage, today was your wake-up call. Leverage in volatile markets is dangerous. Liquidations triggering liquidations. That is what happens when leverage traders get caught on the wrong side. Your stop loss gets skipped. You get liquidated at a price way worse than expected. Your account is gone. If you are using leverage on precious metals, reduce it dramatically or eliminate it entirely. The gains are not worth the risk of total wipeout. If you're sitting on the sidelines with cash, this might be your moment. The best time to buy is when there's blood in the streets. When fear is everywhere, when people are panicking, that is when smart money accumulates. That is when the wealth transfer happens. But only buy what you can afford to hold through more volatility. There might be more pain. Buy in tranches. Do not go all in at once. If you bought at the top, I'm not going to lie to you, watching your portfolio drop 10% in a day hurts. But you have 2 choices right now. Choice 1, panic sell at the bottom, lock in your loss, make it permanent, transfer your wealth to someone else. Choice 2, hold through the volatility, wait for the recovery. Accept that you bought at a bad time, but recognize that timing is not the same as thesis. If the fundamentals are still good, your only mistake was timing, and timing mistakes get corrected over time. History favors the patient. Let me give you some perspective. In 2020, gold crashed 30% in March. People panicked. They said gold is dead. By August 2020, gold hit all-time highs. Everyone who panicked sold, missed the entire recovery. In 2008, silver crashed 50%. People said silver would never recover. 3 years later, silver hit $50. Every single bull market has corrections. The question is not whether corrections happen. They always happen. The question is, do you have the conviction to hold through them? That conviction comes from understanding. If you understand why gold and silver are rising long-term, you can stomach the short-term pain. If you do not understand, every crash will shake you out. Now, there are 3 types of people watching this video right now. The first type is panicking. They are refreshing their portfolio every 5 minutes, letting fear drive their decisions. The second type is frozen. They do not know what to do, so they do nothing. They just watch and hope. The third type is learning. They are taking notes, understanding why this happened, preparing for what comes next. They know that crashes create opportunities for those who are ready. Which type are you? Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational. Today, billions of dollars changed hands. Some people lost that money, other people gained it. The question is, which side of that transfer are you on? If you panic sold today, you transferred your wealth to someone else who was waiting for this moment. If you are still holding, you still have a chance. The game is not over. December crashed, January pumped, January is correcting, February is coming. The pattern is right there. Will it repeat? Drop your thoughts in the comments. I rate every single one. If this video helped you understand what happened, hit the like button. It helps the algorithm show this to more people. If you're not subscribed yet, subscribe now. I do not do hype. I show you what is actually happening. Share this with someone who is panicking, someone who bought at the top. This video might save them from a huge mistake. The correction happened. You cannot change that. What you can change is what you do next. Will you panic and make it worse? Will you freeze? Or will you learn and prepare? The market does not care about your feelings. It only rewards those who understand it, those who prepare, those who have a plan. If you did not have a plan going into today, now is the time to make one. What will you do if we crash another 10%? What will you do if we rally 20%? What is your strategy? Because there will be another crash and another rally. This is how markets work. The difference between winners and losers is not intelligence. Smart people blow up all the time. The difference is preparation. Today tested everyone. Today separated the prepared from the unprepared. Did you like what you saw? The hidden economy, because the real story is never on the surface. Stay calm, stay prepared, and remember the correction happened, but the bull market is not over. The fundamentals have not changed, only the sentiment, and sentiment can flip on a dime. I will see you in the next video.